Good morning. Good morning, everybody. All right, good morning. I think if you can find a seat, we're ready to get started. Good morning, PREA members. I'm Ted Eliopoulos, the current chair of the PREA board, and I'm honored and pleased to welcome everyone to the 2013 Spring PREA Conference. This spring conference, we have some wonderful presentations and programs, dynamic and educational programs organized by these three outstanding co-chairs for the spring conference. A brief introduction. Jacques Gordon is the global strategist for LaSalle Investment Management. Thank you, Jacques. Peter Linneman is the CEO of American Land Funds and KL Realty, and the founding principal of Linneman Associates, and Professor Emeritus of Real Estate at the University of Pennsylvania's Wharton School. Thank you so much for being here. My friend Ken Rosen, Californian, thank you so much for being here, the chairman of the Rosen Consulting Group, and Professor Emeritus of the Haas School of Business at the University of California at Berkeley. Go Bears. Before I turn the program over to Jacques, Peter, and Ken, if I could, I would like to acknowledge the recent loss of a respected peer and colleague and industry leader, Peter Lewis, who was most recently with Tower Watson, was a consummate professional and a kind, generous individual who made a lasting impression on all who had the good fortune to work with him and know him. Our thoughts go out to Peter's family. He will be missed. And with that, I thank everyone for being here. And now, Jacques, I turn the program over to you to begin. Thank you.
I think it would be fitting not to have a moment of silence for Peter, but a moment of noise and active dialogue. So he would like a good argument, as we all know. So I'm not suggesting we're going to be arguing up here, guys. But before we get started, what Peter and Ken and I would like to do is just give you a short overview. First of all, welcome to Washington, D.C. We in Chicago are known as the city that works. What is Washington, D.C., Peter? The city of jerks?
No, it's the
city that mercs? The city that lurks? What is it?
Remember the Let 'em eat cake of Marie Antoinette? This is Versailles on the Potomac.
Versailles, okay. Ken, any comments on Washington and what it feels like to be here?
I'm glad I live in California.
All right. We got your East Coast, we got your West Coast, and we got your straight down the middle Chicago in here. So we should be ready to rock and roll. Before we do, we'd like to just give you an overview of what we've got planned. It's been fun working with you guys to set up a great agenda. Ken, what's up first?
Well, we're doing two things. One, we have a multifamily session this afternoon on whether multifamily has passed its peak or is it still the place to put a lot of money. And so that's going to be, we've got really three industry leaders, and that's, I think, around 2 o'clock. And this evening I have the honor of introducing Bob Woodward, who is one of the few people who speaks up against the imperial presidency. And you saw the recent stuff that he's been talking about, and he's spoken at my conference. You're going to really enjoy him. So we got Bob tonight.
And Peter, what's coming up right after us?
Well, right after us, we have the pleasure of Jillian Tett, assistant editor of Financial Times, having a conversation on global issues, not so much real estate, but global issues with David Rubenstein from the Carlyle Group, which we thought would be a great treat. And then
you can invest in Carlyle now. Did you see that? He's lowered it to $50,000 minimum.
No, it's still too high for me.
Oh.
So, I'm a former school teacher, so it's got to be a lot lower.
It used to be $5 million. Now it's $50,000.
That was for Ken. And this afternoon, there's a session we're going to have on urban investment, urban redevelopment, urban development, with three terrific executives and friends, Mike Fascitelli, Jeff Blau, and Don Wood, and I think they know as much as anybody about the pros and cons and ins and outs. And it's been a pleasure to work with the two of you and Gail and her great staff on this.
Great. And then after great dinner with Bob Woodward, we start off again tomorrow morning here with a panel chaired by Bill Ferguson, and it'll be CEOs of private equity firms. You guys have the REIT guys, and we have the private equity guys tomorrow morning. Steve Fernari, Jeff Jacobson, John Klopp, John Cuckrell, talking about a lot of changes going on in private equity. That should be a very interesting panel, what it's like to be a CEO of that. And then we finish, to keep you with us and not scooting out to the airport, you don't want to miss David Brooks. He's spoken here at PREA, Gail, twice before and has gotten incredible ratings. Of course, on the McNeil-Lehrer, I still call it McNeil-Lehrer, what is it, the Lehrer News Hour regularly, and a great writer in the New York Times, personal hero of mine. So it's going to be a great conference, and our job, guys, is to kind of set the stage for the 2 days and to kind of kick it off with a robust view of what's happening first in the U.S., then we'll move globally, if that's okay.
Sounds fun.
So let's get going. Lots of different ways economists like to talk about what's going on in the world of macro indicators. We've all just experienced a life-changing series of years that have changed really the way economists are thinking about macro indicators. Peter, this was your contribution to the slide deck. What does the slide say to you? What is it
Well, there's two things on here. One is these are real GDP numbers back to 1970. You see the actual in red. You see the enormous drop that Jacques was alluding to, we all know happened. And you see the headline at the end is that if you have a really good eye, you'll see real GDP today is just a little bit above where it was at the peak in 2008. So you come back 5 years later, and you're just about the peak. I guess, dark line is if you would have imposed the 40-year growth rate in real terms from when the recession began, where would we be? So while you can take some comfort that we're growing, and we're actually larger as an economy than we were, there's a huge discomfort that we're $2.3 trillion short of where we would have been had we just grown at the 40-year average. And that's a lot of the dissonance that you see in the economy, which is on the one hand growth, and on the other hand a sense of not being where we should be.
So a couple of trillion below trend is sort of 10% lower?
No, it's actually up to about 15%.
15%. Ken, what's your reaction to this slide? Does it tell the story the way you would?
I would make a little bit of a change in that. I think real GDP growth is going to be slower, and is going to be slower for some time because two components. Population growth is slowing. We had no net migration to the country, and population growth accounts for about a quarter of our growth, and that's gone. So I'm looking at a growth rate that'll be below trend, but the trend numbers were for a different time. And secondly, the labor force utilization. 5.5% unemployment rate is what a lot of people look at as our long-run number, but I think it's going to be higher. We've got a structural unemployment problem that's serious, can't be solved by throwing money at it. It's education. So I'd say it's bad. Peter's right. We've lost that output, but I don't think we're going to get back to the trend in the foreseeable future.
Okay, well, let's pick up after GDP, which is nice to look at, but it doesn't fill buildings. And GDP can be great if you've got great productivity, which we're getting, great earnings, which we're getting, but it's not creating jobs. Ken, this is your slide. What would you like us to take away from it? It's kind of a messy slide, Ken. What do we?
Well, it's messy in the sense that almost all our previous recessions into 2001 were induced by the Federal Reserve tightening monetary policy when we overshot. So they raise interest rates and they slow the economy down, but then there's a quick rebound as they cut interest rates, housing roars back. 2001 was a different recession, a recession that was caused by a financial bubble in NASDAQ and those type of stocks, the stock market, and it took a longer time to recover. And this recession, the bottom line, that red line, It's taken a much longer time. This was the Great Recession. Most decline in jobs we've since the Great Depression in the 1930s. And it was a financial bubble. So all of these financial bubbles take a lot longer to recover from. It's not a Fed-induced situation. And I also don't think it's a Fed-solved situation. So this is a longer way to go. We're still 2% below the peak employment levels. Probably get there in the middle of 2014.
Peter, anything you'd want to add to this?
Well, I think it was a Fed-induced recession. There was a real side that also fed it, there's no doubt. But it was a Fed-induced recession, and they stayed on the gas pedal way too long, way too long. And I think all three of us wrote about it at the time, and set up an even bigger ripple recession down the line. And my fear is they're doing it again to an even greater magnitude. And we'll come back to some of those themes.
I totally agree with Peter on that.
And the only thing I think that happened beyond that was the housing sector being sacrosanct. And bad decisions, but honest decisions by government, just eliminated the rules under which the economy operated. And if there are no rules, people don't invest, they don't take risk, and we've had no rules for a long time. We're finally becoming like Turkey, which is we're getting used to having no rules and growing in spite of it.
Yeah, efficient markets really do need some regulatory rules to set the stage, don't they? Even a Chicago economist would agree to that. Yep. Ken, what is it you're saying here now? We moved to actual jobs per month. We all read these numbers. They come out, they get revised, they're up, they're down. What is it that strikes you about these monthly numbers? What should the audience look for when they get a new look at a monthly jobs report?
Okay, so first let me say that we lost 8.8 million private sector jobs. We've gained back 6.3 million. The monthly rate has been quite strong since October. We get these numbers every month, but they do revise them substantially. So they've been revising up 450,000 over the last year, the job numbers, taking the monthly numbers and revising them all up. So it looks very strong the last 4 or 5 months. This is a level, if we go to 250 a month, that's a level the Fed, if they see that for another 6 months, is going to say, maybe we should start thinking about taking the foot off the accelerator. But one thing to say here, last spring, we had a very strong late fall and early winter last year, and then we had a spring slowdown. The same thing could happen this year, because the seasonal adjustment factors are mixed up because of the Great Recession. We had all the job losses came in a very short period of time in 2008, in the late fall and early winter of 2008 and 2009. So the seasonals there are too big. So it makes the winter look better and makes the spring look worse, when none of that's true. We are growing, we think, 2.3 million jobs annually, and that's a very good number. Washington is wrong to think this isn't good.
So, Ken, just to get your number out on the table, and then Peter, I'm going to ask you, 2013, you would say something over 2 million? Would you?
2.3 million.
2.3.
Exactly,
okay.
2.350. No, I'm just kidding.
All right, and I think, Peter, what would be
I'm in, as Ken, I would say 2.317. But
you get
we're
all the
pretty
upside
close.
then.
No, I get the upside that way. I think everything Ken said is dead on. I think the most important thing people should be watching is the percent of jobs that have been recovered that were lost in the markets you're looking at. If they've recovered 100% or more, it means crudely demand's back where it was, supply is not a lot different. You'll see a healthy real estate market. If you go to a place like LA, where you've only regained about 30% of the jobs that were lost, the supply is the same, demand's off, and you've got it. The other thing I'd add to Ken and to Ken's comments that are very vivid here is that, interestingly, that as things like the sequester start getting on the horizon, and as all the craziness that goes on down here, the private sector actually picked up the pace.
Yeah.
Only people
there have
that
been
are
federal
work,
jobs
absolutely.
and state and local government jobs slashed during these last 5 to 6 months.
When we've cut federal jobs, and I said this would happen, when we've cut federal jobs and state and local jobs, there was a stimulus to the rest of the economy. Namely, you don't have that tax burden facing you in the future. And the private sector got it. Media didn't get it, and Washington doesn't get it, but the private sector has, as Ken's chart shows.
map of the U.S., certainly lots of variations across the country. What would this suggest to you, Ken? This is your slide. Anything to highlight? There's certainly a lot of diversity here. Nobody's in that 5% hot area, but there's some very hot metros.
Right.
What is it you'd take away from this?
Well, there are three sectors that are booming. We all know about energy. Energy is booming. Energy production and exploration. We have a massive sea change in our energy equation that's going to show up in a very big way now, but also over the next 10 years. So that's a Texas, Oklahoma, Williston, North Dakota, the most rapidly growing place in the country. I put that color, 5+%, because it was there. It's slowing a little bit, but still strong. The other major growth industry is technology. And technology includes social media, and we see strength there in places like San Francisco, Silicon Valley, Seattle, Austin, Texas, and New York City. So we see a changing picture. But we also have a cyclical rebound beginning in housing. And so the devastated places in the Southeast and Arizona are all coming back. But remember, this is the growth rate year over year. It's a bounce from the bottom. But Peter's absolutely right. How many jobs have recovered relative to what we lost? So a place like Houston, absolute boom. Seattle, San Francisco, Silicon Valley, Austin. But other places, while they're coming back, LA is coming back. It has only gained back a portion of its jobs. Phoenix, again, looks strong, but it's still only a third of the jobs coming back. So this map shows only one place in recession. The green and blue are very strong growth, and the recession, deep recession, is West Virginia, and it really has no longer a reason to exist. So it may become part of Virginia again. I apologize.
Don't write us.
Senator Byrd may come at you. Peter, anything?
The only thing I'd add is to highlight Ken's point is that these are from the bottom. If you would have put up here sort of the percent recovered, the states would differ a little bit, but you'd get different colors. And I think that's one of the things people miss. This is not, there's no doubt there is a rising tide lifting, but the recession in some places is still going on, and the recession has been long over in other places. In Houston, the recession's been over for 2 years. These are the best times ever. In Las Vegas, if you live there and you're a person there, it's still the depths of the worst recession in their lifetime. And I think that gets lost on people.
Guys, before we leave employment, there's been a lot of discussion about this magic 6.5% unemployment rate that the Ben Bernanke and the Fed minutes are saying is now their new litmus test. Kind of in all our years looking at the Fed, I think this is the first time they've put out a number like that. Now, we all know that there's many ways to measure employment. You have a participation rate, an underemployment rate, you have temporary, you have permanent. Is that 6.5% number a reasonable number? What is your reaction to that? I think if you took your 2.3 million jobs, you'd be all the way out to, 2015 before you actually hit it. So that would imply that quantitative easing and keeping your foot on the pedal could go on for 2 more years. What's your take on that 6.5% unemployment rate signal that the Fed has put out?
I always thought it was something stupid they taught at MIT, but I don't know that was the case. So Ken, you can comment
Actually,
on that.
as you know, Mario Draghi and Ben Bernanke went to MIT. I was there 5 years earlier. We all had the same professor, and his view is print money, Franco Modigliani, a brilliant man, Nobel Prize winner. But I took 4 notebooks in his class compared to 1 notebook in any other class. He talked so fast. But a very interesting thing, 80% of what he said was wrong. 20% was right. They remembered the wrong part. So I've gone rogue. I'm a Chicago school person here on what's going on. I think 6.5, the actual number changes over time with the age structure of the population, with education levels. So 6.5 is, I think, a good point, but I think I would start easing back now. I would not have my foot in the pedal in a bigger way than ever now. They're just doing it too strongly.
Well, the Fed minutes show a division, don't they? I mean, the chair
Yes.
gets a lot of clout, and yet there is a...
They're brilliant. You know, I know Ben, and of course I know Janet Yellen very well, and they're very brilliant people. But I think they're doing something here that's a mistake. So 6.5, I think, is the wrong target to start moving. I would say 7.5, you start moving to normalization, and you get the full normalization by 6. So I'd say, what's the long-run likely unemployment rate today, it's around 6, not 5.5 as they're talking about.
Well, and it wasn't clear whether quantitative easing could be withdrawn before then, and then it's the Fed funds rate that would change at 6.5. They were vague on that. But let's just talk a bit more about this fascinating world of ultra-low interest rates that we're in. Peter, your first take on this. You're showing us 50 years.
Yeah,
of
I
this.
like to show almost 60 years. I'll be 62 on a week from Saturday. So this is essentially
This is your
my
life. Your life.
This is essentially my life. And that's why I put it up. And what it says, in my lifetime, long-term rates have never been this low, and certainly never been anywhere near this low for this kind of time period. And that's with Republicans and Democrats and inflation and non-inflation and unemployment and you name it. Every possible combination of good, bad, and idiots over the time. Never been this low, and you got to question if that's stable. The second is the short rate has never been this low for any kind of sustained period, and we lose sight, we're in 4 years of it at this point. It's negative in real terms. The last time it was this low, you had 20 years run of inflation. Now, I'm not saying night follows day, but there are certain forces, namely you keep your foot on the accelerator long enough, it gets hard to control. And there is an odd sense that, and Ken, you've seen it, Jacques, you've seen it, where academics go to government and they suddenly fall in love with controls. They just believe these models work far better. A model's a model. It's a guidepost, but it's not a machine you drive.
Kenneth Boulding had the line, mathematics brought rigor to economics, and unfortunately it also brought mortis.
Yeah, I think that's a great line.
Okay, so Ken, you did a close-up on this. What this is sort of this is your life, right? You were born in '86.
That's correct.
This is a little bit
That's
of
all he can remember at this age.
Yes, I think the reason I showed this, I really think that this is the relevant portion of the curve. What's happened in the last 4.5 years? Ben Bernanke did exactly the right thing in the crisis, 2008 and 9. No question the right thing. But I think zero interest rates or 0.1% short rates, it's really hard to run a business in the money management area, and it's made the risk-free rate look so low, it's ridiculous. The 10-year bond, which is now about 205 today, also is so distorted. So this price control on money, while it's working to some extent, you're pushing the rubber band so far, the reaction the other direction, we've seen it every time, is going to be quite negative, much sharper rate increases. We think a 10-year bond goes to 5.5%, which I think it should be at today. And we see the short rate being 3%, 3 to 4%. So that's going to happen. If I could get the timing, I would be very wealthy. But and many of you know I've been saying this for 2 years and hasn't happened yet. So I do think this is a mistake. The right thing to do in the first part of the recession, the wrong thing to do when we're in a fairly, I'd say we're 3/4 of the way recovered now.
And the only difference is I started saying the exact same thing 6 months earlier, and I'm now, because they've done so much,
You've been wrong
100
longer.
basis points higher on where the interest rate should be on the long end. I mean, it's just, it's quite extraordinary. It's quite extraordinary.
And these are really smart people. If you want to read a dissenting view, Richard Fisher, who's the chairman of the Dallas Fed, you can look him up on YouTube and the like, he has this talk that would be similar to what we're giving here. He's a dissenter, losing, but very well connected.
Well, how is the room supposed to work off of this? This benchmark rate of 205, which, you know, private equity, REIT markets, high yield bonds are now 5, right? And so it's not,
here's the
everything is priced off of this 205. And you guys are both saying, and I would agree, that it's an unrealistically, unsustainably low number.
It's not even inflation. The long is not even inflation.
So how do we
here's
as
the choice.
investors think about that?
And this is why we've been so crippled, I think, as an economy. The low rates are hurting the economy. You've got to remember, for every borrower there was a lender. It's killing savers. It's killing senior citizens on fixed income. They are reducing consumption. They're reducing the amount of money they're giving to their grandchildren to spend because they're really strapped. It's also hurting because there's no one in this room, if you're honest, who knows what to make of today's investment environment. You've never seen it in your lifetime. And therefore, when you don't know what to do, you do less risk-taking. Now, that's what they say they've been trying to do. 3 years from now, they're going to be saying you took excessive risk. The real challenge is you have to say, is it above my pay grade to worry why 10-year Treasury is where it's at, and I'm just trying to get a spread? Which is what lots of money is doing. It's above my pay grade to try to figure it out. I'm not going to fight the Fed. I'm not going to fight the ECB. It is what it is. I'll just get my spread. The problem is the gap at which it's below where it should be, and I think Ken's numbers are dead on, is bigger than the spread you're getting. That's the problem.
And there is a way to protect yourself. People in real estate typically don't do this, but a simple way is get a long-term assumable mortgage against the property you've got. Another way to do it is you can actually hedge this. You can hedge the cap rate. So I think it's really important to realize that the environment 3 years from now is going to be very different than it is today. And if you're buying a 7% IRR and you have the cap rate go up 100, 150 basis points, not as much as the Treasury, but still up, you're going to have not the return.
How are we hedging this cap rate? Are you saying the debt by the cheap debt?
The way that you all think about doing it is cheap debt, locked up, long-term assumable. There's a problem on loan-to-value, but the way I would do it is I'd short the 10-year Treasury in my real estate portfolio. And I'm personally doing it, but I think it makes a lot of sense. There are also derivatives. You can use some of the same derivatives to hedge interest rates that you can use to hedge the cap
So you
rate.
run a core fund out there. I'm sure at least 20%, 30% of our audience is running core real estate. They should be doing this. They should be
If they don't doing, either they do it in their fund itself,
Or their client, or
the client, the CIO, that says, look, I see this coming,
Yeah.
and I see this coming. Very tough to do that because it's certainly not part of the mandate of any fund. And while it is in the
It's the pay
CIO's
grade.
prerogative to
That's
do
the
this,
pay
it's
grade, yeah.
very, the
Not my
CIO
job.
has
Yep.
to make a big decision. But some CIOs are doing this. They're figuring out how to protect themselves from what I see happening, which is a lot more inflation, not only higher interest rates, but inflation back again.
Okay, so the other common insurance product that a CIO would buy would be tips. So Peter, what are we looking at with that market?
You look at tips, and if you buy a tip, you're guaranteed of only getting inflation. That's it, period. You're getting no real return. You're getting nothing. You're paying the government essentially to take your money and just give you CPI. That's how distorted the capital market
And what
has gotten.
duration did you get? Ken gave me a
This is-
tip slide that showed a negative yield. I think
It was slightly,
Yeah.
it depends on, it dipped up, it just ticked back up.
Yeah.
But this is, if you think about, Ken's comment about its price fixing when he was talking about the wage, the interest rate. It is.
Right.
This is no different than if you started having the government 5 years ago setting corn prices and wheat prices. 5 years later, the distortions that would have rippled through the economy if you didn't change corn prices or wheat prices or go right across.
So instead of a
would be
warehouse
huge.
full of cheese, now we got a Fed filled with MBS and
Filled with all sorts of odd stuff that's rippling onto everybody in this room who's having to say, well, if that's this, I've got to do.
But isn't this slide here really just showing that if you're in the business of paying out